kind of know, don't we, David, what the Fed is likely to do, a half-point rise in interest rates. But the question to me is, what is the level of the Fed funds rate? How high does it have to go ultimately to tame inflation? Much higher than where it is.
It does need to rise. I do think the Federal Reserve will continue to increase it at a relatively rapid pace throughout this year, but they don't have to do the whole job themselves. I think that's absolutely key. This economy's got a lot of braking power in it anyway. And so if they push the federal funds rate up to, say, 2.5% by the end of this year, long rates rising, high dollar, less fiscal stimulus, this economy is going to slow anyway. Inflation is going to turn down anyway. So I think the key thing here is for the Federal Reserve, don't be too aggressive here. Make sure you protect the economy. Don't send it into recession. You don't need to do that because inflation will gradually ease anyway.
Quickly, what are, David, those slowing pressures that you cite? Is it the high dollar that is going to make our exports more even more expensive than they are today?
Sure, high dollar, huge fiscal drag because we've got a much smaller deficit this year. And then also we get a rebound from COVID in the second quarter, but then that's kind of done. And so I think the services rebound will fade as the year goes on. And that's a lot of things dragging the economy down, slowing the economy down. So the Federal Reserve doesn't need to do it all themselves. This economy is already losing momentum.
Mona, now we have to ask where the next stop is on the 10-year. We're already about kissing 3% again today.
Yeah, absolutely. Look, the 10-years moved. It's a double this year. It started around 150. Now we're close to 3%. Do we think that rate of change annualizes? Should we keep going at this pace? Probably not. But could we get beyond 3%? We think 3.5% could be likely. Keep in mind, markets do tend to overshoot both on the upside and the downside. But the key really will be, to David's point, if and when we start to see inflation more meaningfully roll over, that's when we're going to see yields peak and more meaningfully roll over as well. So we think we're perhaps not quite there, but getting closer to a peak in yields as well.
Jim, if we want to get to 2% inflation, how high do interest rates need to go? And what's the risk of a recession implied by that?
So that's the absolute key question. And I think if the Fed is absolutely dead serious about getting inflation to target by 2024, which is the term of their forecast expectations, then I think the Fed funds rate needs to go, well above 3%. So it could be that they go to 3.25%, 3.5%. And the question I always ask, and it's the question that you're asking, Tyler, which is, what is the breaking point for the economy? Where do things really start to slow down? And I think they do once we get above 3%. And that's what we're seeing in equity markets. That's what we're seeing in other markets. Importantly, though, we're not really seeing it too much in the credit markets. Credit spreads are staying well contained at this point. So I think if I'm looking at this from the Fed's view, financial conditions might not be tight enough to control inflation. I agree with what David's saying. I think that plenty of things are going to slow down, but will it happen fast enough for the Fed's liking?
Financial conditions not tight enough, Jim?
I don't think so. Based on where I see credit spreads right now, credit spreads have been hanging in pretty nicely. And it's really a question of having a financial market feedback to slow inflation down within the time frame that the Fed wants those inflation pressures to come down. So that's in the next couple of years. So I would argue right now that, yes, equities have melted down and, for sure, and rates have gone up, but we're not really seeing enough of a slowdown, at least by my calculations, to get to 2% inflation within the time frame that the Fed is specifying without hiking more.
All right, Jim, it is like you knew what time it was because right now we're going to go to Steve Leisman for the news. Steve.
Yeah, the Federal Reserve, I can tell you.
Federal Reserve raising the target range for the federal funds rate by 50 basis points to a new target range of 75 basis points to 1 percentage point. The Federal Reserve increasing, says ongoing increases will be appropriate. The Fed will begin to reduce the balance sheet on June 1. It will ramp up the balance sheet reduction over time. It's going to begin with $47.5 billion in balance sheet reduction through August, and then after that 3-month period, it's going to reduce the balance sheet to allow the runoff of $95 billion a month as expected, and that'll happen beginning in September. That'll be a total of $60 billion in treasuries running off the balance sheet every month, $35 billion in mortgages. The Federal Reserve says household and business spending remains strong. job gains have been robust. The Russian invasion of Ukraine likely puts upward pressure on inflation and weighs on economic activity. A very quick analysis, guys. There's one sentence in here that was a little more dovish than I expected, and a lot of other observers thought there'd be a line in here about the Fed moving expeditiously towards neutral. It doesn't say that. It just says anticipates ongoing increases will be appropriate. Doesn't say how much. We're going to have to leave that for Fed Chair Jay Powell, and whether or not he'll put some character on the pace and amount of tightening to come from the Federal Reserve. But as expected, 50 basis points and balance sheet runoff ramping up to $95 billion a month. Kelly?
Steve, let's highlight two key things here as we're watching a knee-jerk dovish reaction to the statement. We see yields dropping about 5 basis points on the 10-year to 295 and equities moving higher somewhat. The Dow is up 250. It seems like you said they didn't use the word expeditious. Also, why are they doing half the expected pace of quantitative tightening for the first 3 months?
Oh, so no, we expected that. We actually began to survey that, Kelly, back several months ago in the Fed survey that the Federal Reserve would ramp up to the $95 billion. They've done that before. That was, I think, fairly well expected. I apologize for not mentioning it in the lead up to this, but they're going to do that for 3 months. They want the market to adjust to this. Then they'll get to $95 billion.
So you think this is, what do you think then, Steve, are the dovish surprises from the statement? No dissenters.
Just the one comment here. I saw a bunch of people, and because Powell went forward and said we're going to move expeditiously back to neutral, people thought that was going to be the new sort of buzz phrase that told us 50s were in and around or possibly coming for the statement. But that was not adopted in the actual language here. We'll see if Powell uses it again. Expeditiously to neutral, to put numbers around that, Kelly, the way people understood that is 50 basis point hikes to 2.25, 2.5. They didn't say that. I'm not going to go overboard here and say this is a dovish statement. Remember, the Fed raised by 50. Remember, the Fed is going to $95 billion a month in runoff. So don't lose sight of the trees here, or the forest here for the trees. I think the story here is whether or not the Fed is getting behind this idea of all of those 50s en route there, and whether or not there's some play up and some play down here.
All right, let's stick around, Stephen. We're going to bring back our panel, plus Bob Pisani and Rick Santelli also joining us. Rick Santelli, let's turn to you. What are you seeing in the bond market?
You know, it's unbelievably trim and quiet considering. Now, it's a lot of price volatility and yields moving, but just consider, we were at 279. That's where the market was right before Steve Leisman started to read what the Fed was going to embark on. So basically, it's unchanged. And definitely some stochastic process going on there. 297 was where 10s were exactly before Steve started to read the statement. That's pretty much where they are now. The yield curve, 10s to 2s, was separated by about 19.5 basis points, exactly where it's at now. So what I think is the aggressive tendencies of the Fed have to be embedded in the marketplace because the Fed isn't going to back down. You know, they're basically putting a block on their shoulder and say, knock it off. Inflation, we're going to deal with you. We're going to squash inflation. So they have to have that unified front. But in reality, the market's pricing in my estimation, worst case scenarios that most likely aren't going to happen. Now, do I think the Fed isn't going to embark on a big tightening cycle? Of course I do. But I just think that going back to 2018 and 2019, perfect examples. In 2018, we had some tightening. Powell was tightening. And the markets, the same markets we're quoting now, we're showing 3 more tightenings in 2019 that turned into 3 eases. So I'm just saying that we need to slay inflation. You need to have a unified front of being tough. But you can't back down at all, even though deep inside, I do think the Fed understands that inflation, at least caused by supply chain issues, is going to moderate. The problem is there's lots of inflation that isn't, like labor inflation. Right now we say, you know, you're not getting paid as much as inflation's going up. But my guess is in 2 or 3 years, that's going to reverse a bit. We're going to see higher wages stay, and we're going to see some of the inflation levels actually dip below that. I think the Fed's doing as good a job as possible considering they waited too long.
All right, thanks very much, Rick Santelli. Let's go now for a look at the equity market to Bob Pisani. Stocks rather cheered, it would seem, Bob.
cheered, but very muted. Same thing with the equity market as the bond market. We were moving actually before the Fed announcement, a couple minutes before, 41.86, and then right after that, we were moving up and moved to 42.10. We're right around the 4,200 level right now, so fairly muted reaction. I think the issue for everybody down here is, has the market priced in enough Fed hawkishness? We're talking about 3% Fed funds at the end of the year. Powell has implied he wants a soft landing. The stock market doesn't believe that he's going to be able to deliver on that. That's the big problem. So can you do a soft landing or not? And the problem is, at the meeting, I think you're going to find out, or at the presser, you're going to find out, he can't imply that they're not going to be even more aggressive. He can't take 75 basis points off the table. And if he doesn't, that's going to imply an even harder landing. So it's hard to argue for a soft landing when the Fed isn't going to stop with the aggressiveness overall. I can tell you one thing. There is a very bullish opinion being pushed that inflation is peaking. That's going to cause the Fed to back off later in the year. Powell himself addressed this recently at the IMF panel. He said it may be the peak will be in March, but we don't know that, and so we can't count on it. So Powell himself has told the bulls, don't expect us to back off just because you see inflation peaking in March, and I think that's what's going to keep the markets on edge for a while.
All right, Mona, let's turn to you for some reaction and analysis here. Takeaways?
Yeah, absolutely. You know, I think generally what Rick had mentioned is right. I think the markets have priced in a very aggressive Fed. What we may hear from them today is no explicit dovishness. It does not make sense for them to be dovish when inflation has not yet moved. But if they are asked about a 75 basis point rate hike or an intra-meeting rate hike, and they don't explicitly endorse it, the market may take that as, on the margin, a slightly dovish reaction as well. So I think they will put their foot on the pedal, but they may not explicitly endorse some of the most aggressive forms of tightening. And I think that's what we'll be watching for to see what their path is going forward and how the markets may react to it.
Jim, Caron, same question to you. What were the big surprises for you here?
Well, you know, I think that the Fed will likely continue to be very, very hawkish, but it seems that the initial statement wasn't overly hawkish. So I think the markets have taken a little bit of a reprieve from that. The one thing that I'll say, though, is that we have to respect the initial conditions. The economy has been strong, and we're coming from a very, very strong footing. The equity markets, for example, have been very, very strong. Now, clearly they've weakened, but we're coming from a very, very strong place. So what it seems to me like is that the markets are still a bit unafraid of the Fed. Now, the only issue that I have with that is that if the Fed wants to use their financial conditions to contain inflation risk, which is what they can do, that's what their policy is designed to do, then I would argue that the markets probably have to go through a little bit more pain before the Fed actually achieves its goal of pushing inflation to the levels that it wants to, and that they're confident that will actually get to that target inflation point. And I don't see that quite yet, so I'm still a little bit nervous about the markets going forward. Today, right now, might be okay, but going down the road, I'm a little bit concerned.
David, why don't you react to what Jim just said? Are the markets insufficiently afraid of the Fed? I think that was one of the takeaways I took there.
No, I think the markets are probably getting this about right. I think the Fed is fundamentally dovish by its nature. They've been squawking like hawks over the last year because inflation's been high. But the reality is, as the economy moves forward through the end of this year into next year, it's going to slow, inflation's going to roll over, and the Fed doesn't want to make the typical mistake of waiting too long and then doing too much and putting the economy into recession. And I think that, Jay Powell at this press conference is going to be asked a lot of questions along the lines of, are you afraid of tipping the economy into recession? I think he's got to reassure people both that we're pretty confident inflation will come down, and no, we're not going to overdo this and put this economy into recession. I think that will be comforting to markets.
Steve, let me turn back to you, and we've talked a good bit about the interest rate question. Let's talk about the balance sheet and the pace at which it may decline. $9 trillion right now. It's going to start at about $47 billion a month, if I'm reading right, between treasuries and mortgage backs, and rise to $95 billion. Why didn't the Fed go there sooner? That was a way to get into this tightening a little quicker.
Why didn't it go to $95 billion?
Well, no.
Quicker?
Why didn't it begin?
Tyler?
Why didn't it begin squeezing the balance sheet sooner? That's number one. And what do you make of the pace that it is embarking on now?
So I think that the Fed not going sooner is one of the biggest mistakes the Fed has made, maybe since I've been covering them. I mean, they all sort of felt like they should have stopped buying assets. They were doing so, Tyler, incredibly through March, a time which was the same month that they reversed course. They had a plan to do something, and they wanted to be, I guess the only excuse you could give is they wanted to follow through with their plan to do something through March. They did so, and then they reversed course almost automatically. It's part of the reason they have to be a little more firm now in terms of raising rates, probably why they're doing 50s now. They probably should have stopped. Powell made a pivot a little bit late, not crazy late in November. You could argue maybe he should have done it in September, but you could say he still had a COVID crisis to deal with back. If you remember, there was another outbreak. Okay, so he was a little late in the rhetorical pivot, but he was much too late in terms of the pivot when it came to buying or stopping the purchase of assets in QE. Let me just say real quickly, Tyler, when all is said and done, I hate to do something too quickly after a statement comes out. We're now, 11 minutes after liftoff here, and I see very little change here in the Fed funds futures market outlook. I'm still seeing them price in 450 basis point rate hikes through September, which means you get to that sort of nebulous neutral rate of 2.25, 2.5 by the September meeting. There's maybe something less of a chance of a 75 basis point rate hike built in, maybe a little bit that came off the boil, but not entirely. It's still 35% for June or July. So I happen to think that this is exactly what Powell wanted. He set the market up for this report or these actions. He gave it to them, and the market at the moment seems to be kind of even and flat on getting exactly what Powell told us we were going to get.
On that note, Rick Santelli, a final thought from you here. The 10-year, which initially dropped about 5 basis points on the statement, is a little bit higher again. I mean, 297, 298, that range. What are you watching?
You know, I am watching the 2s to 10 spread. It's just the easiest way to kind of handicap what's going on the shorter maturities that have been more aggressive in their rate increases because they're more closely tied to the Fed overnight rate. And the long end, of course, has a variety of issues. Investors like to buy higher yielding instruments, even if they're not necessarily in positive real rate territory. And, of course, we have this notion that the long end is going to be our canary in the coal mine, so to speak, on whether the recession, which is caused by inflation and bad policies and mistakes, not by raising rates, which is actually the medicine. And I think that by watching that, if we get around zero, that's not going to be a very good thing. And if we see a bit of steepening, I think that would be a better thing.
All right. There's the 2s10 spread, just under 20 basis points. And big thanks to our panel, everybody. We really appreciate your thoughts, your reaction, your analysis this hour. Mona, Jim, Rick, Bob, and David Kelly, and of course, our Steve Leisman. You don't see him in the picture there because he's going over to ask some questions to Jay Powell at 2:30 when the press conference starts. Coming up here, we have more analysis and reaction to the decision from a former governor who's been critical of the central bank, plus Ed Yardeni on the potential still for a soft landing for markets and the economy. We're just moments away from this market-moving press conference with Fed Chair Jay Powell. Keep it right here.
Let's go. 50 basis points, a half percentage points in layman's terms, and detailing more on the balance sheet runoff. This is what the markets kind of expected, but we're still waiting to hear from Chair Powell, which we will in about 13 minutes' time. Here now to react is former Fed Governor Robert Heller and Ed Yardeni, president of Yardeni Research. Welcome, both of you. We're glad to have you here. Mr. Heller, I'm struck by something in my notes where you say that really to get inflation tamed, the Fed fund rate needs to be positive, i.e. above the inflation rate, which would put it at something like 7 or 8%. That would spell recession or maybe even worse, wouldn't it?
Well, both boom times as well as recession times can cause high interest rates. If we're in a big boom, if we have a lot of inflation, interest rates will be high. But at the present time, the Federal Reserve has to step on the brakes and actually slow down the economy. And therefore, we got to have positive real rates. And that means a much, much higher Fed funds rate than we have at the present time.
So you would have liked to have seen them raise by how much today? A point, 2 points, what?
Yeah, the more the better. They should have raised a long time ago. Now they're behind the curve and they're in a box. They have to raise it very high. They're talking about 50 basis point steps, but that will not stop inflation for a long time to come.
So, Ed, I don't know whether you agree with Robert or you disagree, but I do know in my notes that you say a lot of people are asking you, so why not just do it? Get it, go more aggressively sooner and take the rate to where you think you're going to be able to effectively slow inflation and do it fast.
Right. Well, to your first question, I am in a opposite camp. I think that 2.5% to 3% of the Fed funds rate is going to slow the economy down enough to help bring inflation down. Inflation isn't totally a monetary phenomenon. That's something we've learned over the past 10 plus years. The Fed is, remember when the Fed tried to bring inflation up to 2% with very easy money and couldn't do it? There are other factors at work operating on inflation. And I think the supply chain disruptions is certainly an issue which will get increasingly resolved. We've really had a tremendous inflation led by consumer durable goods, used car prices, new car prices, appliances, bedding. I mean, these things just don't keep going up at 15 to 20%, which is what we've been seeing over the past couple of years. I think they are going to start simmering down. I think we had a demand shock that was stimulated by way too much fiscal and monetary easing. And now I think we're going to see that the demand for goods is satiated to a large extent. Pent-up demand is satiated. We're going to see some strength in services. So I think the Fed is actually going to accomplish a soft landing. I'm not in the recession camp.
Ed, I wonder, though, if this doesn't capture the potential for higher services inflation that's coming. It almost feels like we're going to be in a Twin Peaks situation where we had the goods spike, and that was one thing. But how do you get rid once it's embedded? I mean, look at HCA's results the other day. Health services inflation. Look at what everyone from Tupperware to Lyft has said in the past 24 hours about wage inflation.
Sure. Yeah, I think you're making a very good point, a very important point. I think on the services side, the main trouble is going to be on rent. As we know, rent inflation right now is quite elevated. New leases, by some accounts, nationally are up 12 to 15% on a year-over-year basis. With a lag of about 12 to 18 months, all those new leases get into the pool of leases, and we'll see that in the CPI. My forecast is that the consumption deflator inflation rate will probably peak within the next few months at 6 to 7%. And then I think it's going to come down to to something like 4 to 5% by the second half of the year. So I think we will see a peak. It's still going to be high. And then next year, I think we get down to 3 to 4%. And the year after that, 2023, I think we could actually get down to 2%. I think what the markets want to see and what the Fed wants to see is some credible evidence that we're peaking. We're not going to go back to 2% anytime soon. I think that's pretty obvious to everybody.
I'm going to ask the esteemed Mr. Heller to respond to the esteemed Mr. Yardeni, who seems to feel like 2.5% on the Fed's fund rate is going to do the job in slowing the economy and slowing inflation. You disagree. You think those rates need to be 3 times as high.
I totally disagree. As you keep pouring more liquidity into the bathtub, the water level rises, and that will lift all prices of all the commodities, of all the ships afloat. Inflation will continue to increase. You got to get the money supply much, much lower. At the present time, it's growing at over 10% after having grown 25% in 2020 and 21. So there's tons of liquidity, and we see that liquidity working its way through. I'm an old man. I've been there in the 70s and in the early 80s, and it will not end pretty.
Ed, go ahead. Yep. And also inject some advice for investors here, because from what you're saying, it sounds like they can just kind of relax and, all will be well.
Well, all will not necessarily be well, but I think there's way too much pessimism out there. And I think there are lots of analogies between the inflation now and the 1970s. But one of the huge differences is productivity collapsed during the 1970s. This time around, I think we're going to see productivity really pick up. Productivity growth actually bottomed on a cyclical basis back in 2015 at 0.5%. It's already up to 2%. I think it's heading up to 4.5%, which is what we've seen in previous productivity cycle booms. The reason for that is there's a shortage of labor, and companies, I think, increasingly are going to scramble to increase the productivity of labor. In terms of investing, I think it's too late to panic. I certainly wouldn't be selling here. Probably made a lot more sense at the beginning of the year if you saw all these things coming. But look, it's very hard to call corrections, and I think this is still a correction. You have to call both the top and the bottom. And right now, a lot of people who might have taken some credit for calling the top, I think, are going to miss the bottom.
I want to get a quick final thought from Mr. Heller, if I might. One of the things that worries me is that I'm not sure we've seen the top inflation in such things as fertilizer, wheat, corn, and natural gas because of the war in Ukraine. What say you?
I fully agree with you. Those are contributing factors, but the essential factor is the excessive monetary expansion. And the Federal Reserve never talks about money. What's monetary policy without looking at money? That's my question.
All right, Mr. Heller, thank you very much. Ed Yardeni, great to see you, sir. Always a pleasure.
We can't keep up with these markets, by the way. Just a moment ago, the S&P and NASDAQ had turned negative. Now the S&P is back positive. The Dow's up 100 points, where it looked for a second like it might go lower. It tells you just how jumpy we are ahead of hearing from Fed Chair Jay Powell. His press conference begins in just about 5 minutes' time. We'll bring it to you with some last-minute analysis and setup next. From hearing from Fed Chair Jay Powell himself, his first in-person press conference since January of 2020, after the biggest rate hike in 2 decades. Quick check back on the markets as we get set up for that. Shows they're all back in positive territory. We've had some pretty big moves here. Just 2 minutes ago, the Dow was up 40 points. Now it's up 270. So these are session highs. The S&P up 27, the NASDAQ up 24.
There is a lot of trading going on. I bet a heck of a lot of it is algorithmic trading, probably machine-oriented trading. As you see there, the spread between the 2-year and the 10-year, about 20 basis points or thereabouts. Let's go to Bob Pisani as we wrap up this abbreviated edition of Power Lunch before we hear from the chair. Talk to us, Bob.
Tyler, we're just about where we started, maybe 10 points higher in the S&P. There's 2 problems for the markets right now. First, it wants to be convinced that Powell can engineer a soft landing, but it doesn't really believe it because it knows that Powell has to maintain the inflation-fighting credibility and so leave the possibility even more aggressive rate hikes are on the table. That's going to keep people on edge. The second problem is the Fed is not going to be deterred by this argument that inflation might be peaking in March and April. Powell said earlier at various roundtables, we don't know if inflation is going to be peaking right now, and we cannot count on that. And because of that, you're going to see people who are going to be out there arguing, well, the inflation's peaking, therefore the Fed's going to back off. Powell has already said we can't do that. We can't rely on that. We have to make sure that we're fighting inflation. So the Fed's credibility is really at stake here, and that's why I think he's not going to take more aggressive rate hikes off the table at the 2:30 meeting. And that's going to be the first question anybody is going to be asking him. Guys?
Remarkable to see stocks breaking out really towards session highs. We should check on the financials, some of the other key sectors as well. Give us a little bit of that flavor. Dow up 240, S&P up 24, NASDAQ, which had been the big laggard today, up 15. And there are the financials. They're up about 0.75%.
All right. We're waiting for Fed Chair Powell to approach the podium down in Washington. This, I think, is going to be a live press conference for the first time in a very long time. Our Steve Leisman is in the audience, in the room down there, and as we get ready to see what he says, and there is the room. And there, I can tell you, that is Steve Leisman's head right there. And there is the chair.